So Matteo basically talked about how these discount rates get estimated. And I think Stefano will kind of now bring it back to the major topic of the class and tell us what it is that you can learn from these estimates, you know, about climate change, climate risk, and value in climate change. So thank you, Stefano. Over to you.
Right. Okay. First of all, thank you, Johannes, and I completely agree with Matteo's story. That was exactly how the paper started, and also to the ability of Johannes to get data is incredible. All righty. So let me do. You guys see my screen?
Yes.
Okay. Perfect. So what I'm gonna talk about today is this already moved on its own. What I'm going to talk about today is another paper that Matteo and Johannes and I worked together. This one is with our two co-authors, Andreas Weber and Krishna Rao from Giglio. And basically, it's trying to kind of push the idea that, you know, now that we have these estimates of long-term discount rates, you know, what do we do with them? And how do we make them speak to the question of climate change? Okay. So, you know, the question is really the same question that Matteo already kind of addressed at the beginning of his talk, which is, you know, there are obvious, climate change is an obvious case where these long-term discount rates clearly apply, okay? Because it's a case where, you know, we're thinking constantly about investment decisions for which we're going to pay the cost in the very short term, but the benefits are going to arrive, they're uncertain, first of all, and they're going to arise, you know, potentially long time from now. And also, the present value and your decision you're going to make is obviously very sensitive to the choice you make about discount rates. Now, the idea of this paper is to try to is really twofold. Is one, to kind of provide some new evidence about the exposure of housing to climate risks. And basically, the argument we're going to make is that housing is a particularly useful asset to look at if we want to learn something about climate investments, okay? And the second point is to try to bring all the empirical evidence that we have together through a model, okay, to actually be able to say something quantitative about, you know, indeed how you should make investment decisions related to climate change. And before I start talking about the details of the paper, I want to kind of emphasize how important this is when we think about climate change. So if you want to take a stand in a quantitative sense about, you know, what kind of projects should we entertain, how do we compare different projects, you know, they have different cash flow risks, different horizons, it's very important that you have kind of a quantitative framework that allows you to make quantitative predictions. And a quantitative framework that allows you to talk about climate change needs to include basically the dynamics of climate change, like the physical processes of climate change, the physical process of the economy, right? The interaction between the two, and people, right? The utility of people that allows you to kind of make comparisons and think about wealth. And so, you know, ultimately, every time you need to make a prediction or some sort of counterfactual analysis, you need to have a model. And writing down models about climate change is extremely hard because, in a sense, we know so little about many of the pieces of it, right? We know very little about the ultimate, you know, physical processes. We know little about the interaction with the economy. And this is why, you know, it's important we get data from everyone we can. Okay, so of course, there's going to be in the future, it's already started, but there's a lot of work that tries to kind of combine together what we know about the economy and about climate change processes together. But that's why we think it's particularly important that if we have, you know, evidence that comes, for example, from the housing market, which we argue is informative of climate change, we should try to put it together in a model, okay? And so that's why we wrote a paper where we say, okay, what can we learn from this particular piece of information, which is our long-run discount rates in the housing market, okay? So the other of what I'm going to talk about today is basically, we're going to split the presentation in two parts. I'm going to first talk about the empirical evidence we have about kind of the special role the housing markets play in helping us think about climate change. And second, I'm going to give you one proposal of a very simple structural model that contains all the elements I talked about that, you know, that allows us to kind of think through different counterfactual projects of different counterfactual situations of different investments to mitigate climate change. Okay, and again, I should emphasize, this is in a sense, it's a prototype. Okay, it's one example how you build the model. It's certainly a very simplified model. It's not the ultimate rich model. It just shows you kind of a roadmap on how you build this kind of models. Okay, so let me get started with empirical evidence. So I'm gonna kind of restart from what Matteo showed you. I'm gonna, you know, obviously I'm not gonna review any of the details, but I want to kind of restart from his concluding point. Okay, his concluding point was, if you look at the housing market, okay, and you try to back out what are implied discount rates, Well, what do you find? You find that for the very long term, you find very low discount rates, about 2.5%. And in the average return from housing market is about 6%, which implies that in the housing market, we see a downward sloping term structure. Okay, so somehow, for whatever reason, which I'm going to explore more later on, investors want to get very high risk premium, very high compensation for risk for holding short-term housing risk, but much lower compensation for risk for long-term cash flows. But I should emphasize that this variation, we believe that this variation between the short-term and the long-term discount rates is mostly driven by risk premium. Okay, housing is a risky asset. Okay, in good times, house prices go up. In bad times, house prices go down. And in general, you would expect that investors would like to get a risk premium. So they will apply to the housing asset, to the housing market, discount rates which are above the risk-free rate. Okay, and why are they different across maturities? Because either the preference for risk or the quantity of risk is different for different maturities. Okay, there's something special about the short term. There's something special about the long term that make them different in the view of investors. And we're going to talk about what does this tell us about climate change. Okay, so keep this fact in mind. The second fact I want to talk about is instead, and is truly more new for this paper, is that housing truly plays a special role with respect to climate change because it's uniquely exposed to climate change risks. Okay, and so in this paper we focus a lot of energy in trying to have a good measurement of this risk exposure. Okay, now why is housing exposed to climate change risk, and what is a kind of a very natural asset to look at when we're trying to quantify investors' preference for climate change risk? Well, it's because obviously, housing is very tightly related to the land, and risk and climate change exposures are themselves very directly tied to the location. Okay, so whereas, for example, you might think of, if you have a firm which is exposed to climate change risk, you may think of, either relocating the firm or maybe changing the business of the firm or adjusting your production process. There's a lot of flexibility when you have a firm, for example. For a house, the house, if a house is located in an area which is exposed to climate change risk, well, there's very little you can do about that. Okay, and so we think that housing is a prime asset to look at when we want to think about how investors perceive climate change risk. Okay, so the exercise that we want to do in this part of the paper is to ask, how do house prices reflect climate change risk? How can we quantify this exposure? Okay. Now, the most natural approach to this would be to say, well, let me compare two houses. One is close to the coast, so very exposed to, let's say, flooding or sea level rise, and another house which is not so exposed, and compare the two, right? Basically doing the simple difference between houses which are on the coast and houses are inland. Now, of course, this is a problem. There's a problem with identification because it's very likely the differential exposure to climate change between these two houses is also differentially correlated with amenities, right? So you have a house on the coast, yes, it's more exposed to flooding, but also has a beautiful view and access to your kayak on your weekends, okay? And so obviously it's clear that there's a very important issue with the variable bias. So what we do in this paper is we propose an alternative identification that exploits the time series changes in climate change risk. Okay, so what we're going to do is we're going to do a different. We're going to compare houses on the coast with houses in land. We're going to compare how their prices vary as climate risks change. But here's where another obstacle comes in, because actually climate risk is a very slow-moving object. It's something that evolves over decades or centuries. So how are we going to be able to distinguish with the little data we have how prices change as climate risk changes? Okay, so we're going to use the following approach. Okay, we're going to construct a climate change attention index, okay, from real estate listings that allow us to do the definitive. The idea is very simple, is that even though the climate change process itself is very slow moving, people's perception of the risks is actually potentially quite frequently changing. Okay, so we're going to exploit basically high frequency variation, okay, in attention to climate risk. And that's gonna, and to the extent that the investors and people who are buying houses are indeed changing their perception of risk together with this variable, then we should see something, we should see prices respond to this perception, okay? So what we're gonna do is we're gonna construct a climate change attention index, and we're gonna say, how do prices of the house which is more exposed versus less exposed to climate risk change in a relative way as the attention changes, okay? Now, we're also gonna try to address the problem that which is a different obstacle to identification, which is, okay, but what if these changes in attention is just driven by some actual events that are physically damaging the house, right? If I have a house on the coast and there's a hurricane that destroys half the house, it's true that at that point it becomes more salient, climate change risks become more salient, but it's also true that the price of the house may have declined, not because people became more worried about climate change risk, but simply because the house was actually destroyed. And like Matteo mentioned already before, we're going to get at this problem by using a rental data. Okay, so now that's kind of the roadmap of where we're going to go. So let me get there little by little. So first of all, let me tell you about the cross-sectional variation in exposure to climate risk. What do? We look at 4 states, Florida, New Jersey, and the Carolinas, that are very clearly exposed to climate risk because they are coastal states. And we're going to overlay our information about house prices and housing locations with the NOAA maps of exposure to 6 feet sea level rise, okay, which is kind of the projection for kind of the worst case scenario for the next 100 years or so. And basically for every property that transacts, we're going to ask, is this a property that is at risk to becoming flooded within, with a 6 feet sea level rise or not? And you can see here, this is a map of downtown Miami. For every house, we're going to say it's, we'll have a house which is green if the house is at risk, and red if it's not. And what's nice about this is you can see there's a lot of very local variation. Okay, so you can see, to the block level, that within the same block, there are houses that are more exposed and houses that are not exposed. Why? Because, because there's variation in altitude, in altitude of the houses, in elevation, right? There's variation in the geography of the place. There's variation in, for example, where the highways are located, which are natural barriers or artificial barriers. So there's a lot of actually very local cross-sectional variation that we can exploit to try to keep the other elements constant. And so this is the cross-sectional variation. Now, how do we deal with the time series variation? Well, what we do is for each zip code and each month, we look at the real estate listings from Giglio, and we parse the text of the listings looking for keywords that indicate that people are paying attention to climate change risk. Okay, so we look for basically places in which, listings in which the sellers point out something related to climate change. Here's an example, right? This is the house, which is a 4-bedroom, blah, 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 in the Carolinas. And then the listing says, well, look, it's not in a flood zone, it's high and dry. And then again, a few paragraphs later, only 15 minutes to the beach, not in a flood zone, okay? So then we count for every zip code, and in every month, we count how many of our listings, what fraction of the listings actually in that zip code, in that point in time, talk about this kind of climate risk exposures, okay? And we construct our index. And this index has also itself nice both cross-sectional variation, geographic variation, and time series variation, okay? So here's a map of Florida. You can see that in the different colors correspond to different average level of the index. You can see that there's quite a bit of variation within Florida. And on the right-hand side is a time series variation in Florida. You can see there are times where people are less attentive to climate risks and times where people are more attentive to climate risks. Okay, and so again, the identification will come from the interaction between the cross-sectional exposure from the NOAA maps and the time series variation from this climate attention index. So the main result of this part of the paper is going to be this regression. If you look at the first 2 columns, this is a kind of standard hedonic regression on the left-hand side with log prices. And then we're going to have a bunch of property controls or even property fixed effects. And then we're going to have the indicator of the flood zone, and the coefficient that is of interest for us is this interaction between the indication whether you're in a flood zone and the log index by that is varying by zip code by year. Okay, so you see here a significant estimate of minus 2.4%, which indicates that when the local attention index doubles, houses that are in a flood zone, everything is equal, decrease in price by 2.4% compared to those houses that are not in the flood zone in the same area. Okay, everything that is equal. Now, this tells us, okay, ultimately the bottom line is that house prices are indeed exposed to climate change risk, and investors are pricing that in. Okay. Now, let me just address the last point, which is, what if this is all due to the fact that, in some areas at some point in time, there was a hurricane or, a flood or something else that destroyed the actual house? Well, the idea is if really there was physical damage, you should see that also reflected in rents, right? Rents, a house which is half destroyed should also rent for less. But when you do the same analysis on rents, which is on the right-hand side of this table, you see that actually that's not the case at all. Right? There's no negative response on rents to these changes in climate risks. Okay, so it's something that is captured by the price because the price is compounded, kind of very forward-looking potential damages and risk exposures, whereas rents only look at the present don't. Okay, so to us that's pretty convincing evidence that indeed house prices reflect the house prices are exposed to climate risks, and the investors are aware of that. Okay. So now let me tell you how we would put everything together with the model. This is obviously the most challenging part, and I think that's where a lot of future work can come in and kind of refine and enrich this model. Okay, so let me start by telling you a little bit about this. So what kind of implications can we build from these empirical results? I'm gonna split the empirical evidence in two parts. The part is more model free. There are some very important things we can learn about discounting kind of long-term climate change mitigation projects that does not actually fully rely on the model. Okay, and the intuition is actually very simple. It follows very directly from what Matteo told us before, but I think it's important to point it out before we move to the model. Okay. The point is very simple. Okay, if housing is a risky asset, okay, then all these estimates about discount rates, they must be all above the risk-free rate. So, for example, for long-term, hundreds of year discounting, discount rates must be below 2.5%. Okay, in other words, if risk premia are 2.5% for a risky asset, then the risk-free rate is bounded above by 2.6%, and any climate investment there is actually hedging invested that mitigates our climate change risks must be discounted below the risk-free rate, which itself is below 2.5%. So already from this very simple economic analysis, we learn that investment in long-term climate mitigation, to the extent that we believe that that's mitigating some of these climate risks, well, that must be bounded above by 2.6%. We shouldn't apply discount rates above 2.6%. Okay? You can see it's a very simple point, but it's a very important point, because if you look at the literature, and the papers have studied and proposed different models to think about long-term investments, well, many of them have come up with numbers that are actually above 2.6%. Okay, so a very standard approach is to say, look, let's apply to climate change mitigation investment a cost of capital approach. Okay, so what's the alternative use of capital is to invest in, let's say, in standard capital, and maybe that has a discount rate of 4%. Well, that can be. Okay, we already learned that for anything that has a hedging property, for any investment that can hedge climate change risk, we can't have anything above 2.6%. Okay? And this is a representation in a sense of this point. I'm going to show you where this calibration is coming from later when I talk about the model. But imagine this kind of calibration that fits with the data that Matteo talked about before. You should remember with this kind of high short-term discount rate and low long-term discount rate. Well, this is what the test structure of discount rates for a risky asset like housing looks like. The risk rate has to be below this one, and so any discount rate that you use for discounting climate change risk has to be below the risk rate, and therefore clearly below this blue line. Okay, so 2.6% is the clear upper bound for long-term discount rates to apply to climate change investment. Now, to make stronger quantitative recommendations, then we need to take a stand instead of the model. Okay, and that is a lot of work. Okay, because we need to take a stand on the physical process for the economy, the physical process for climate risk, the interaction between the two, the way people form the beliefs, and the way that people's preferences think about, people perceive and have preference about future climate change risks. Okay, so that's what we do in the paper. I'm going to give you, in the 10 minutes or so I have left, a quick review of the paper without going too much into the details. Okay, a quick review of the model. So our model is a model that combines rare climate disaster risk. So think of the temperature kind of increases as the economy grows, we're polluting the environment, the climate change risk increases. Once in a while, we're going to reach a tipping point, which is going to result in a climate disaster. Okay, and that's going to make consumption drop. Okay, and it's going to feature endogenous feedback between the economy and the climate. Okay, This process, so both the physical process and the economic process can be calibrated to the empirical data we have, in particular to what we learn from the housing market, okay? And then we're going to use this calibrated model to consider different climate investments and think about, okay, exactly for different types of investments, which discount rate do you want to use, okay? And again, the bottom line is, even though the recommendation, the quantitative recommendation will depend on the exact assumptions you make, all of these climate change investments are going to be discounted at low rates because they're all bounded above by the risk-free rate. Okay, so let me just give you the main ingredients of the model, okay? So it's a very simple model. There's aggregate consumption growth, okay? That's the first equation. And aggregate consumption growth has a persistent component XT, but is hit by this potential rare large disaster risk, which happens when the climate reaches its tipping point, okay? That's JT, okay? So think of JT as something that it's zero now, it's zero most of the time. Once in a while is 20% or 30%. But the economy, okay, also reacts not immediately when the disaster hits. When disaster hits, there's an immediate shock to the economy, but then the economy kind of partly recovers after a disaster, okay? So we're gonna have this phi positive in our calibration, which means that when the disaster hits, it's true that there's an immediate drop in consumption, but then in the years after, the economy is gonna grow a little bit faster to kind of catch up a little bit on the losses due to the current disaster, okay? This is trying to reflect the idea that, the economy after a climate disaster, we're gonna have adaptation, okay? Humans will engineer a way to adapt to the climate disaster, and the economy can start growing again, and part, not fully, but part of this loss is gonna be caught up to later, okay? So basically, we're gonna have this is how the economy responds to climate change, okay? The second set of equations is a special set of equations for houses, which is very similar to what happens with aggregate consumption. And then there's this other side of the economy. You always need to think about both. The other side of the economy is what happens to climate risk. So lambda t here is the probability of this climate disaster. And that's changing endogenously with the economy. In particular, I want you to notice that here there's a new times xt. Xt is the expected consumption growth. And so what happens here is, because we're polluting, in times where the economy is growing fast, where xt is high, where lambda t is increasing too. So the more the economy grows, the more the probability of this climate disaster is increasing, okay? So you see there's this two-way feedback, okay? The climate feeds back in the economy when the disaster hits, but then the economy feeds back into the disaster when through pollution, okay? Now, this process is actually quite rich because it also features, persistent this probability of disasters. You see this autoregressive component lambda t, but also the fact that potentially when disaster hits, it can actually predispose the economy to further disasters, which is something that's been talked about in the disasters literature, okay? These kind of vicious cycles in disasters. So you can see with just three equations, I actually represent the very complex dynamic system that represents both the economic side and the physical side of the economy. I'm going to just give you a couple of examples of what kind of dynamics this model can produce, right? Here's an example. So in this graph, this is just a path over time, okay, of the economy. You have here consumption or rents in the bottom graph, and on the top graph, you have the probability of disaster, okay? So the dotted line here, the dashed line, is kind of the economy on the steady state growth path, okay? So when nothing happens to the economy is growing, and then the probability of disaster is kind of at its steady state. So that's zero in the top graph. But now suppose the economy starts growing faster than expected, faster than the steady state. You see the economy, you see that the solid line kind of departs from the trend in the bottom graph. The economy is growing fast, well, it's polluting more. And so the probability of disaster accumulates. And for a while, the disaster probability increases, okay? So this shows you the feedback from the economy into climate change. But then, just to give you some additional, in an additional example of the past, suppose that after a while, indeed, there is a disaster, okay? So at time 25 in this graph, the climate disaster hits, the economy kind of drops, right? Consumption drops, okay? Consumption drops, you can see from the top graph, there's a further probability of another disaster, which doesn't materialize. And look what happens to the economy. This is going to be very important for later. The economy drops today, but then you see it kind of starts growing again pretty fast, okay? There's this kind of mean reversion in the growth rate is going to be very important to be able to match our asset pricing facts. So what we do in the papers, we take these models for the physical economy, we make a very simple assumption about people's utility, which is just a power utility, And we say, okay, what is a good calibration that matches, our facts about the exposure of climate risk to the economy, our facts about the time structure of discount rates, and what we know about the structure of the risk-free rate, okay? The calibration is going to have endogenous implication for all of this, okay? And I want to just show you what we find, okay? So this graph is indeed the graph that is calibrated from our model about the structure of discount rates for these risky assets, which is housing, okay? And now, what Matteo told you before was, look, yes, we can write down a reduced form model that generates this term structure. I want to now tell you why our model endogenously generates this term structure of discount rates. Well, that's because of what we believe happens with the dynamics of the economy. So the intuition is the following. In this economy, okay, you might be holding short-term assets or long-term assets. If you hold a short-term asset, you're short-term housing asset, okay, you're very exposed to the disaster risk, okay? Because if the climate disaster happens, your rents are going to be very affected, and you're making a big loss on your capital, of your investment, okay? But if you hold the long-term assets, yes, it's true that maybe over the next 100 years there's going to be a disaster, but there's also going to be this mean reversion. You can see it here from this graph. You see a long-term asset benefits. Yes, it's hit by the drop, but also benefits from the faster mean reversion. So in a sense, the long-term assets are kind of safer than short-term assets because they price in the adaptation is going to occur after kind of disaster. Okay, so this very simple model, which is complex but simple enough to solve and calibrate, allows to explain why we would see the decline structure of discount rates in the housing market. But in addition, it allows to do a lot of different counterfactual exercises. I'm not going to go to the details here, but basically the idea is you can then say, okay, let me take a particular climate change mitigation project with a particular cash flow structure, okay? A project, for example, hedges a certain fraction of future climate risks. What should the term structure of discount rates on this particular project be? And you can use the model to get quantitative implications about this. So the three black lines, one is solid, the other two are dashed and dotted. You see they correspond to three different investments, each of them more of a hedge, okay? And this calibrated model tells you exactly which are the discount rates you should be using on these three investments, okay? So for example, the one that is the best insurance, that completely covers all your damages from climate risk, which is a dotted line, which is kind of an idealized investment, should have very low discount rates for the short term. Big Y, in fact, negative, because those are hedges. That's the insurance for you. And still, over the long term, always still very low discount rates, both in the short and in the long term. As you can see, as we predicted from the beginning, all of these discount rates on these hedging investments are going to be below the risk-free rate and therefore strictly below the 2.5%. Okay? And so this shows you is just an illustrative example of how you can use our model to make quantitative predictions about the kind of discount rates you want to apply to different types of investment. I'm going to conclude here. I'm going to say just two things. First is this, as I said, this is not a final model. This is just a first step in how we can think about building models that allows to actually make take seriously the quantitative implications of our findings. Okay, and I want to conclude a little bit by just saying that thinking through the climate change problem. It really shows how many kind of nice challenges and opportunities we have in front of us, okay? Why? Because climate change is an incredibly complex problem, and I think that finance actually has a lot to say about that. And a lot of the lessons from finance that were, somehow ignored in much of the existing literature in climate change economics. And I think nowadays there's been a lot more dialogue between finance and standard climate economics, and I think we've been able to make a lot of progress on these fronts. There's a lot of many open challenges. I just thought it would be nice, being this a PhD class, to close with some of the things that we kind of need to do a much better job at, okay? One is, for example, how do we measure climate risk and risk exposure? The day-to-day, many of the panels you saw today were exactly about this, about, how do we measure climate risk and climate exposure of different assets, okay? A separate problem that we know very little about is the perception of climate risks, right? It's very important because, of course, climate risk is going to be reflected in prices only to the extent that people understand that risk. And so I think it's very important to work on the communication side and the perception side to understand really how much people do internalize these different climate risks. And of course, what I hope was clear from our Lipton model is how hard it is to integrate all the data together, the empirical, the empirical data from prices, what we know about from the physical process, from the simulation, the physicists are doing. How do we integrate all together, and how do we take into account the huge amount of model uncertainty we have? Well, that's a lot of work still to be done. And this, I think, is a really exciting area to work, and it's going to keep us busy for many decades. And that's it. Thank you very much, Johannes, for inviting me to discuss about this. You're muted.
Thank you so much, Matteo and Stefano. I just want to again re-emphasize that you see a lot of common themes, I guess, across the many papers we're presenting today. And the next two papers after a short break for everyone, both Nancy and then Amine and Matt's paper, think about housing markets and then kind of take it to the next step and start thinking about mortgage markets, which are obviously very, very closely related to housing markets, and so on. So, the exposure measure, but really, I think on the modeling side, it is worth just re-emphasizing this. And I set this out, in the beginning, in the introduction, that, kind of have this fundamental challenge between sort of having extremely complex climate models that we get from our friends in the physical sciences, and they're using computers that we can't, supercomputers we don't know how to work with, and just to kind of think carefully about the climate side, and obviously we want to then also think about the interaction with the broader economy, etc. So it's a much richer set of topics we want to do. So how do you go and take these complex physical models, distill them down to their essence, distill them down to the few elements that are the most central for the interaction with the broader macroeconomy, and then kind of try and do asset pricing within those models, or try and think about hedging within those models, think about risk pricing within those models, etc. I think we know how to think about risk as financial economists, and so this really interesting new stuff is this physical process that kind of has these feedback loops going both ways, as Stefano really nicely showed, going between climate and the economy, and then economy feeds back into the climate through CO2 emissions that come as part of economic growth, etc. So I do think there's a lot of really cool stuff that can be done there, and maybe in the panel we can come back a little bit about sort of what are maybe promising directions there.